Hello, everyone. Brian Love, head of Banking and Fintech at Travillian. Today's episode is all about compensation. So it's 2026. The war for talent is not cooling off. It's accelerating. Community banks can talk about strategy, technology, and capital all day long. But the real differentiator, as my guest will tell you, is people. And people respond to how they're being paid. For years, many banks treated compensation as a back office exercise. Today, it is front and center strategy. The linkage between incentive design and how a bank actually makes money and the storytelling between has never been more critical. Compensation can be emotional, but it should be viewed as a true investment. On this episode of Travillian Next, we sit down with a leading incentive compensation strategist in the community bank space to discuss how banks are evolving from activity-based pay to performance-based economics. Mike Higgins of Mike Higgins Associates is a nationally recognized advisor to community banks on incentive, compensation design, and governance. He works with boards and executive teams to build performance-based frameworks that align individual contribution with shareholder return, create self-funding reward pools, and remove emotion from annual pay decisions. His work spans production roles, executive compensation strategy, and long-term incentive alignment. So welcome, Mike. How are you today?
Hey, I'm doing great, Brian. Honored and flattered to be on the show today.
Yeah, well, you know what? I was thinking about how we met, and I think you knocked on my door because you watched one of these podcasts several years ago, and you enjoyed it, and we got to know each other. And you're one of the nicest guys in the industry, so I appreciate the viewership and your interest and joining us today.
Yeah, thank you for having me. Yeah, the things that you touched on initially, it's if we kind of talk about what we're seeing upcoming, it's kind of more of the same from the last couple of years. It is an absolute war for talent, and the way I kind of like to frame that discussion, as you alluded to, is first of all, we work in a highly regulated industry, so that really kind of defines the way the game has to be played, and then it's highly commoditized on top of that. So how things are delivered and the products are very, very similar regardless of your organization. And so if those things are kind of constants, what gets down to the one variable that really makes a difference? It's people. It's not necessarily the logo on the building or the logo on the shirt. It's the people that walk into the building or the people that put on the shirt, to me, that make the biggest difference in this industry.
Yeah, well, and you're speaking my language. You know, we're helping sometimes very small banks under $1 billion, $2 billion in assets try and punch above their weight, which is problematic, very specifically sometimes with compensation, of course, from like one group of banks to the next group in asset size and above. So this is a topic that absolutely always comes up in my work, and, you know, super excited to get into some of the things that you're doing. I think the first question I have for you, Mike, is I'd love to hear about some of the banks that you've helped. You have a few clients that are decades old. What have you helped them with historically, if there's some specific banks you want to mention? And what are you helping with them more recently? How have things changed?
Yeah. I've got a great kind of case study example. The bank is called Austin Bank, and they're in down in Texas. And a lot of people think it means it's in Austin, Texas. No, it's named after the Austin family. It's kind of, I know it's kind of unique. No
Is
relation
there a
to.
Houston bank in Austin? Like,
Yeah,
no,
yeah.
joke.
They're kind of rural East Texas, if you will, kind of the north side of Houston, and runs up all the way the east side there, a couple hundred miles. But it is fun working with a family-run bank because they're more concerned about what their name means in the community than extracting profit out of the community. So that's kind of one of the neat things. But the story started, really, I started working with them in 2001. Jeff Austin Jr. was tired of the parade of people that would come into his office at the end of the year and say, "What's my bonus going to be? What's my bonus going to be?" And he just didn't like the way they were doing it in a very subjective manner. And it was very frustrating to me. He said, "Mike, we really kind of need to structure this a little bit differently." And so what we did is we came in and we said, one of the key objectives is we want this reward plan to be self-funding, because I don't want to put a limit on how much people can earn, an arbitrary cap or top on it. And if it's self-funding and balanced, meaning we've got some counterbalancing measures. For instance, we're going to reward for lending. We're going to have some counterbalance on pricing and fees and asset quality, and maybe bringing in some deposits as well too. We want it to be robust. And so we structured that. And the first year, about half the people got it, and they were really successful. And the other half It took them a little, and Jeff came and said, Mike, I want you to come down and visit with the team every year for a couple of years. And at the end of the second year, Jeff gave the proverbial, hey, the train is leaving the station, and Mike's our guy here. And then finally everyone started to accept that, okay, we've got to understand how we make money and how that contributes to our success. And I think when we started working with them, they were just over 500 million in assets. And this last year, they cleared 3 billion. So it's really kind of a neat success story.
How are you making it self-funding?
Yeah. Yeah. So what we do is this. A lot of times reward programs that I see are built around the KISS principle, keep it simple, stupid. And I think that the problem is that keeps individuals simple and stupid. And that's not the type of employee that we want. We want to have the smartest group of bankers working for us. And there's this disconnect between job description and how I can influence the bottom line. And I really like to make that separation. Nobody in an organization controls anything. If it was that way, we just turn up the control dial and life would be easy, but it doesn't work that way. It's how we influence things. And so if once you start to bridge that gap and say, listen, the outcomes that we're looking for are we need to make some money. So that's the outcome that we're going to incent for, not the process to get there, because you can game the process. So first of all, one of the important things is having the ability to measure this stuff. If you've got that, then you can make it self-funding, and you simply say, hey, I have an expectation of X level of performance driven by the factors in banking that lead up to that. We can monetize that performance with precision. And then we say, when you clear that, we're going to maybe share 5 or 10% of that with you, kind of almost like a commission on profit. And then they can say, great, we don't care how much we pay you because we know we're keeping the residual. That's kind of the process.
Just like a self-fulfilling prophecy. If they produce, it creates the revenue that obviously pays for their incentive.
Right.
Now, okay, so I appreciate you talking about Austin. We were talking before this, and the education piece is interesting to me. I used to be a community banker. A lot of the viewers probably heard me talk about it many times, but I'll never forget going to this all company meeting at one of the banks I worked at. There were probably, 400 people in the room. And these slides started coming on the screen in front of the whole audience. They were SNL Financial, like in the little corner, you saw it before it was S&P. And it was ROA, ROE, efficiency ratio. I had never seen them. I was basically a branch manager and then a small business banker. I didn't even know what I was looking at. And luckily there was some explanation, but there wasn't a lot of follow-up about these specific metrics. So I'm kind of the epitome, Mike, of what you're saying about really understanding how the bank makes its money. Like you could simply say that, like it's deposits and loans and it's a churn, but there's more to it than that. So I want to dig into that. How are you advising your clients with that revision of the job description and that education piece?
Yeah. Yeah. To me, that's the key linkage that you've got to close there. The frustration that I usually see people having is, and quite frankly, this is universal in all industries, not just banking itself. Banking is a little bit of a specialized industry in that we make all our money on the balance sheet rather than the income statement. That's kind of backwards for most people's experience. But I think we need to start introducing these concepts to our staff. It always stays at the management level, and they're so versed in it. It just is so intuitive. And sometimes I even see it where the people that live by these numbers don't understand them well enough to explain them to somebody else. And that's where the breakdown becomes. But you just have to make that investment to start to do that. And I kind of hate to look at, I generally a positive person, but sometimes the management teams are like, our staff aren't capable of understanding these things. That's really insulting if you think about it, to say, I don't believe you're capable of understanding these measures and how you can influence them. And you just got to break out of that mindset. I mean, if you think about it, you've already taken an employee in their whole life, you can't teach them this kind of stuff. It's really disappointing.
Well, we're not rocket scientists. We're bankers,
Yeah.
right? Do you have any memorable times where maybe you've been helping in that education, or do you leave it up to your clients to do it?
No, there's kind of two things. I tried to lay the framework down for that. And part of, the process that we go through is there's a little bit of educational component talking about how different elements create to profit. One of the simple notions sometimes I think people lose sight of is, we're taught deposits are interest expense. Well, no, everything works on spreads in this industry. So if I bring in an interest-free deposit at 0 while I'm waiting to loan it out, I can earn 3.5%. overnight on that. Gee, that might be one of your more profitable products. But they don't understand these concepts of spread. When you teach them that and maybe put an example like, hey, if you brought in $1 million of deposits at zero, here's the amount of money we make. You bring in $1 million of CDs at 325, and we invest them at 350. That pays someone's salary for a week. Now I understand there's a difference. Not all deposits are the same. So we help with some of that, but like any good relationship, at some point the bank's got to take it and run with it a little bit too. And the ones that embrace that and run with it are the ones that are the most successful.
Yeah, and actually that bank that I referenced that I worked at, there was a message of low cost deposits are gold. Like that's what your job is. Get deposits under 25 basis points because that's
Yep.
the coal in the engine, right? That you can shovel into the engine. So, but still, like I'm not sure that that same message was being had at other banks down the street. My bank was a little bit unique. Anyway, well, also in these positions, I was a commercial lender, small business banker, deposit generator. I did a lot of different things in my time in banking, and I loved it. And production roles of all those types are in such high demand right now. I mean, there's inbound calls weekly that I'm getting from clients in every geography looking for deposit generation people, lift outs, CNI lenders, real revenue producers. You said to me that sometimes in conversations, you would tell these people they're being paid to originate loans, but that's not true in your opinion, right? What is true?
Yeah, you hire these people to make you money.
Yeah,
That's their job description, is make us money. It's not
let's
matter of
call it
fact,
what it is.
I always get originations isn't anything. If more balance is running off than you're originating, you haven't done anything. So to take that example of a producer, what we effectively do is we make a little bank of one. We say, hey, listen, here's your loan relationships, and here's the yield that they're generating. If you're bringing in deposits, we're going to allow those deposits to fund those loan relationships. If you do a bad job at bringing those in, you're going to buy house money. House money is going to fund those relationships, and house money is expensive. It's going to be a lot more. It's going to be more. The marginal cost of funds is what we're going to charge you. So that creates a natural incentive for that loan officer to go, oh, so what you're saying is if I bring in deposits, that's going to lower my cost of funds and my bonus goes up. Yeah, because it lowers the bank's cost of funds and the shareholders win at the same time. So that's just a great example of having something that's aligned with the bottom line, but also benefits the individual and the stockholders at the same time.
Well, there's a lot of psychology that goes into this, and there's a lot of just patterns that have been
Yep.
created over decades and decades of banking. I remember some of the best lenders I knew wanted to do that one thing, right?
Yep.
Put the money on the street, get the borrow in the door. And the
Yep.
deposits and the merchant services and all those other ancillary ways to make money for the bank were kind of like a third, fourth, fifth thing they would worry about. And the banks that really get it right are the ones that marry the whole picture together, retail, commercial, and everything in between. Do you have any good stories of two things? One, a bank that's getting it right. And two, what exactly do those incentive plans look like? Like what's the breakdown of what those producers can get paid?
Yeah. So building off your example there, I think one of the biggest shortcomings of many plans I'll see is they're overly prescriptive. We're only going to pay for this, or we're going to just narrow it down to this and that's it. Well, first of all, the shortcoming of that is they'll maximize the this you want at the expense of something else. So that's the first shortcoming. We like to take an approach that's a little different that says, hey, everyone might have a little different level of expertise, or maybe certain things are a little bit easier to get, or they like to focus on certain things. But I like to give them all the arrows in the quiver. So again, going back to that bank of one concept, I'll say the way we're going to measure is literally an individual P&L and balance sheet, just like a bank. So how can you make us money? Deposits, loans, margin, fee income, treasury management, cash management services, all those things. We're going to give you all the arrows in the quiver, so that if I'm good at maybe chasing the big deals, but we don't get the margin, that's great. If I'm not so good at that, my niche is I can kind of find those middle-sized deals where there's not a lot of competition. I get more margin out of that. So I'm not going to have the big balance, but I'm going to have more margin. That's great too. If I'm a C&I lender and I do a whole lot of fee-based income, great, you can have that too. So we don't like to be overly prescriptive. I'm more interested in the income that you're making for us than anything else. You see where I'm going on that?
Percent. And that's, I mean,
Yeah.
that I think is probably the moral of this conversation, right? It's not a commodity. It's like, like you said, the income that comes in. Are your incentives, they must all look different from bank to bank.
Yes and no. And I'll describe what I mean. The business model is a known quantity. How we make money, right? Net interest income, non-interest income, non-interest expense, and credit loss. So that's kind of the constant. And that's why I really just focus in this industry, because I don't have to reinvent the wheel and go, well, how do you make money? What are your marginal and variable costs and all that stuff?
Yeah.
So it's really the same. And it just gets it goes back to that educational concept. And when you start tying their reward to the outcome you're looking for, that classic Charlie Munger quote, you show me the incentive, I'll show you the outcome. Well, let's focus on the outcome. And the psychological piece is, well, this is how you're paying me. I better learn how we get there. It kind of takes care of itself.
Mike, you were talking a little bit more about how you analyze lenders and production people. I'd love to hear about that.
Yeah. Yeah. This is something that's always challenged, because the traditional benchmark that they might look at is portfolio size or how much they originate. I kind of like to take more of an investor view of the world. So we'll go into a bank and we'll say, hey, let's have the information on your lenders, the portfolios that they're holding and what they're generating, and fee income and the yields and cost of funds and stuff like that. We have a measure that I call a base comp efficiency ratio. So it's like a traditional bank efficiency ratio. I'm looking at their base salary relative to their net revenue contribution that they're producing. Say we walk into a bank and they might have 15 or 20 or 30 lenders, and we'll just do that analysis on all of them and we'll stack rank them. And so the smaller the number, the better. That means your base comp is a smaller portion of this big number that you're generating. And then what we usually do is we'll stack rank them, and then we'll just kind of divide them right down the middle in half. So I know, hey, we've got evidence that half of the population of officers are performing at this level or better, and the other ones are above. And so when it comes to goal setting, we'll say, hey, listen, all of you, we want to pay a market level of reward. We want to be fair. So how do I treat the stars versus maybe a new hire or a recent hire? How do I treat them fairly? Again, put this investor's hat on. The ones that are less efficient are my growth stocks. I'm going to expect their income to be growing. I'm going to assign them more significant growth goals, because by definition, they're either doing the wrong things or they've got a lot of free time on their hands that they need to start making use of that time more effectively. So I'm going to pay them to grow the revenue, which increases the value of the bank, aligned with each other, and I'm paying them to do that. On the other hand, I've got the performers that are really doing well, maybe my top quartile, I call them bonds. And I just want to keep on clipping that coupon every year. And I might say, you know what? If you're in that top quartile, you don't have to grow your portfolio. I'm going to pay you a market reward to stay where you're at, because you're such a good deal for the bank. The other thing too you want to look at is if their comp efficiency ratio is too strong, it's too small, maybe it's time for a base pay adjustment, because the last thing you want to do is lose one of those top performers to your competition. So that's kind of my investor hat that I try to put on in creating that.
No, that's a refreshing perspective. I do have one last question, and it seems to be my little calling card, so I'm just going to try it with you. Do you know what it's going to be?
But I know you always do a question at the end. I'm
Well,
not prepared, but I'm ready.
all right. It's nothing about incentives or banking.
Right?
Maybe it
Yeah, I
is.
kind of figured.
What's your favorite movie, Mike?
Oh, well, one of the ones that anytime it's on, you probably guess what it is, because it's always on TBS or TNT, is
Shawshank?
Shawshank. Yeah.
Oh
Yeah.
my goodness. I
Yeah.
guessed it.
Yeah. Yeah. When that's on, I cannot change the channel. It's like, I'm hooked. I'm hooked. It's probably one of my favorites.
Such a good movie. What is it about the movie that you love? Is it that the relationship the two unlikely people kind of create between each other? Is it, good versus evil? I don't know. What do you think it is?
Yeah. It checked all the boxes. And Andy was a banker.
Oh, that's right.
Yeah.
Andy was a banker. We need to add that to
Yeah.
the pantheon of bank movies that we're
Yeah, exactly. Yeah, no, it's
keeping
all
track
those
of.
things. It's a classic story of redemption. He's very clever. I love the scene when they're up on the roof, and he kind of negotiates his way to get Cokes for Coca-Colas for everybody, or
Yes.
maybe it was beer. I can't remember what it was, but
Yeah.
it's good on so many levels.
Oh, 100%. 100%. Well, I appreciate that. And you're right, you can't go wrong with that movie. I saw that movie with my father back in 1994, and he loved it, and I loved it.
Yeah.
So I have a good experience. By the way, last thing, is your father still with us?
Yes, he is. Yeah, my father
Oh,
was a community banker. That's where I kind of learned a lot about the business then. And yeah, he still is. I'll have to send
that's
him the link to the
awesome.
podcast. Yeah.
Oh, that's great. And the namesake is the same.
Yeah, yeah. A
Yeah,
quick community bank anecdote. Growing up
please.
as the son of the guy who was the community bank president, little Grand Island, Nebraska, and Lincoln, Nebraska, where we lived. And anytime we'd go to a restaurant, I know what it takes to be CEO. We'd go to the hostess stand, and I knew it'd take 20 or 25 minutes to get seated because you're saying hi to everybody in the room. You're constantly on, but he just loved it. His personality was absolutely built for what he was.
So poor little Mike is sitting there like hungry for pancakes or something.
Yeah,
Dad's shaking hands and kissing babies.
yeah,
Yeah, well, I'm
yeah.
sure that had a profound effect on you, and I'm sure you know how to deal with people in our industry really well. I appreciate you coming on the pod, Mike. I hope 2026 is a wonderful year for you and the firm, and maybe before too long you can come on again.
I can talk about this subject for a long time.